What if I told you that one morning you wake up, log into your favorite exchange, and XRP simply isn't there anymore? Not because the project failed, not because it was delisted, but because the circulating supply available to trade effectively vanished overnight. That isn't clickbait and it isn't fantasy. It's the kind of supply shock that appears when liquidity, narrative, and timing collide. When it happens to XRP, the tape won't climb politely. It will reprice, it will gap, and it will force participants to chase a moving target. If you own even a small bag, the next 12 to 24 months could redefine what those coins mean for your future. This video is for education and entertainment only and is not financial, legal, or tax advice. Nothing here is a recommendation to buy, sell, or hold any asset. The views expressed are opinions based on publicly available information that may be incomplete or change without notice. Cryptocurrencies are highly volatile and carry risk, including loss of principal. Always do your own research and consult a licensed financial advisor before making investment decisions. This channel has no affiliation with Ripple XRP or any exchange or issuer, and no compensation has been received for discussing any asset. Past performance is not indicative of future results. Most people won't be ready. They'll hesitate, they'll second guess, and they'll only believe the move after it has already happened. Tonight, I'm going to walk you through the playbook, mechanics over memes, so you understand the structure, the signals, and the psychology behind an overnight supply squeeze. No sensationalism, no wild promises, and absolutely no financial advice. Just the map the pros use so you aren't caught flat-footed when the market stops asking nicely. Start with first principles. Price is the point where supply and demand agree to meet at a moment in time. Crypto adds a twist, float. A network can have a large fixed supply on paper, but the tradable float, the coins actually for sale near the current price, is often a fraction of that total. Once supply migrates to cold storage, treasury wallets, programmatic escrows, or long-term holders with a thesis, it stops circulating. Exchanges keep only a thin layer of inventory to make markets, and market makers hedge that inventory with tools that work until they don't. When demand overwhelms the thin layer, the book doesn't gently adjust. It gaps. Quotes vanish. Offers reappear higher. That gap risk is the core of a supply shock. What does exchanges run dry actually look like? Your app won't show a literal zero. Instead, you'll see thinner quotes, wider spreads, larger jumps between price levels, and OTC desks quoting above the screen because they can't hedge at the last trade. You'll see visible depth at 1% and 2% from the mid-shrink, while price grinds up. You'll see best offers pulled during fast moves. That is how a vanishing float presents in the wild. It's not a headline, it's microstructure. On-chain dashboards sometimes show exchange-labeled balances trending lower. Labels aren't perfect and they lag, so don't obsess over any single address or any single venue. Focus on direction and rate of change across multiple sources. If aggregate exchange balances drift down while spot interest and search traffic climb, you have a classic demand-dominant setup. Coins are going somewhere they typically don't return from quickly. Private custody, institutional vaults, or wallets run by people who are not selling the first green candle. That migration shrinks the float. Shrink the float enough, add demand at the wrong time, and the market reprices by necessity. History already gave us a blueprint. During prior squeezes, XRP printed enormous one-day volumes and skipped price levels the way an equity short squeeze jumps across empty shelves. It wasn't magic, it was plumbing. Too much money chasing too few coins. The question isn't whether that dynamic can repeat. The question is whether today's conditions are as favorable or more favorable than before. To answer that, we need to layer macro, microstructure, and psychology. Macro first. When policy expectations tilt easier and liquidity windows open, capital hunts for velocity. It crowds into the obvious trades first, then rotates into places where small flows move price a lot. Settlement-grade tokens live in that second bucket because throughput, finality, and low fees convert tiny frictions into huge differences at scale. If you're building tokenized rails, you want fast, predictable settlement. If you're allocating to a basket of digital assets, you want exposure to the assets that the rails actually use. You don't need to forecast every central bank press conference to appreciate the incentive. When funding costs ease and collateral rules relax, money moves out the risk curve. Crypto's always-on nature and thinner floats magnify those moves. Microstructure next. Imagine 3 layers of liquidity. Layer 1 is visible. Bids and asks on the screen. It looks deep until a real order hits. Layer 2 is shadow liquidity. Market makers and OTC desks who can take the other side only if they can hedge risk somewhere else at a tolerable cost. When hedges fail or quotes get one-sided, shadow liquidity steps back. Layer 3 is structural supply. Holders actually willing to sell at today's price. Escrows, treasuries, cold storage, and conviction wallets don't count here. Structural supply is the float that pressures the book when demand appears. In a squeeze, Layer 1 evaporates, Layer 2 widens, and Layer 3 proves smaller than anyone guessed. Make it concrete. Picture a venue showing $1 million of offers within 1% of price. Across venues, maybe tens of millions are visible. Now picture incremental demand of $5, $10, or even $20 billion per day. Numbers this asset class has seen. You don't massage through that gracefully. The book clears. Algorithms lift. Makers widen. Basis opens. Perp shorts get tagged. Basis ARB funds buy spot to short futures, which paradoxically adds more spot demand. Each turn of that wheel reduces what is left at the screen price. The path looks like a staircase until it looks like an elevator. How will you know it's starting? Watch 5 practical tells. 1. Aggregate exchange balances trending lower over a 7 to 14-day window. 2. Spot volume leading derivatives, not the other way around. 3. Funding staying reasonable while price and spot climb. Hot funding without spot is fragile. Rising spot with modest funding is durable. 4. Order book depth near the top getting thinner while price grinds up. 5. Rotation. If majors stall while settlement and utility names show relative strength, the spring is tightening. You don't need to call a date. You need to recognize when conditions have changed. Let's talk scenarios because frameworks beat predictions. Base case. An orderly squeeze. Daily spot rises toward 10 to 15 billion. Exchange float drifts lower. Spreads widen a touch. Price stair steps in a series of impulsive days, 20, 30, maybe 40% cumulative, then prints higher lows into a range while funding cools. High case, an acute crunch. Daily spot pushes into the 20 to 30 billion band. Visible depth thins. OTC quotes skew higher. Momentum systems chase. Shorts get tapped, and price doubles into a new band faster than feels reasonable. Extreme case. Shock plus rotation. A macro catalyst nudges risk on at the exact moment the float is tight and flows rotate toward settlement rails. Daily spot surges past 30 billion for multiple sessions, perps gap, market makers protect, and price jumps into double digits, then refuses to revisit the breakout even during volatility. Not in a straight line, nothing ever is, but in a series of repricings that establish successively higher floors. Why XRP specifically? Because the redesign of financial plumbing is accelerating. Tokenization is moving from slideware to pilots and production. Payment corridors, messaging standards, and bank rails are migrating to infrastructure that values speed, finality, and cost predictability. A ledger optimized for settlement has natural leverage to that shift. Tiny frictions multiplied across trillions become real money. In earlier cycles, the narrative was about potential partners. In the last cycle, it was regulatory uncertainty. Today, it's systemic integration, interoperability, and compliant on-ramps. That is a different foundation for demand. Walk through a trader's eye view inside the shock. It starts with a quiet bid. A large buyer accumulates through time-weighted orders, resting bids a tick below price, absorbing every dip. Market makers notice and raise their quotes while staying inventory flat. Then a catalyst hits, maybe a custody green light, maybe a tokenization milestone, maybe a macro line that tweaks policy expectations. Price lifts, retail algos wake up, social mentions climb, spot pushes, perps follow, funding rises but not dangerously. Depth at 1 to 2% thins, a feedback loop starts, higher prints attract momentum, momentum forces shorts to cover, covering requires buying spot or lifting offers, and every lift removes more inventory. You can measure it in the book as the gap between ladder levels grows wider. Psychology is the hidden gear. Most people operate on narrative, not mechanics. They want a reason, news, to explain price. Mechanics don't wait for stories. Stories arrive afterward to justify the tape. The emotional path goes boredom, surprise, disbelief, fear, capitulation, euphoria, regret. The edge is deciding your behavior before volatility shows up. If you invest, the enemy isn't volatility, it's inconsistency. If you trade, the enemy isn't being wrong, it's staying wrong after the evidence changes. Plans beat vibes, definitions beat feelings. Let's go deeper with numbers so you can see how small frictions scale. Suppose a fund decides to build a $500 million spot position over a week. They won't smash market buy, they'll slice the order, hide size with iceberg orders, and ping multiple venues plus OTC. Day one, they test with 20 million per hour during liquid sessions. Makers lean in and fill them, hedging risk with perps and baskets. Depth looks fine, fees are tolerable. Execution looks clean. As the slice continues, frictions compound. The top of book that looked comfortable on Monday looks thin by Wednesday. Implied borrow tightens for anyone trying to short the move. Basis trades appear as relative value funds step in to capture the spread, which, again, requires spot buying. The fund increases the slice because the fills look great, not realizing their own flow is part of the reason. By day 4, every dip is shallower, every rally extends a bit further, and OTC quotes start to sit a tick above the screen. Here's where linear turns nonlinear. A headline drops, perhaps not even about XRP specifically, just a broad digital assets allocation note from a major bank, or a macro print nudges policy tone. Algos scrape it, buy baskets, and the fund's steady flow lands on top of a trend-following wave. Perps gap up, short liquidations trigger, makers protect. The visible book hollows out. OTC quotes chase. What was supposed to be a controlled 500 million build becomes a 2-day scramble to pay up and finish before the window closes. That scramble shows up on your chart like an elevator, now basis. In quiet markets, the annualized difference between futures and spot can sit in a boring low single-digit range. During squeezes, that spread widens because participants are willing to pay a premium in futures to get exposure without sourcing spot. Basis ARB funds respond by buying spot and shorting futures to lock the spread. They are not bulls or bears. They are capturing basis, but their spot buying is real demand that eats into floating supply. In extreme conditions, the ARB itself helps drain what little inventory remains. Underappreciated gear, correlation hedges. Market makers don't only hedge with the same asset. They delta hedge with baskets, majors, and proxies that move similarly in normal conditions. During a squeeze, correlations break down, the hedge stops tracking. Rational market makers widen and shrink size. That mechanical decision removes liquidity from the screen exactly when it's most needed, amplifying price jumps. Custody matters because institutions behave differently from retail. A retail trader can pull assets off an exchange to self-custody in minutes and move them back whenever they want. A fund uses qualified custodians, tri-party agreements, and committee approvals. When they acquire spot, it often settles into custody and stays there until a policy changes. Coins that leave exchanges for institutional vaults are statistically less likely to feed back as sell pressure during the first green candle. Over time, that shift in who holds the coins changes how shocks propagate. Compare elasticity across chains. Bitcoin has size and depth, but settlement time and fee variability limit high-frequency cross-border flows. Ethereum has programmability, but fee and throughput constraints at the base layer push complexity to roll-ups and bridges. A settlement-optimized ledger with finality, speed, and cost predictability has a different elasticity curve. Each new real-world use case doesn't merely add demand. It multiplies the relevance of the asset as neutral settlement. Scarce things with real-world jobs tend to reprice when demand scales faster than supply can adapt. What about escrow dynamics and scheduled releases? Programmatic supply isn't the same as floating supply. If releases are predictable and if a large fraction is relocked or held by operators with long horizons, the effective float remains constrained under fast conditions. Markets respond to what is for sale now, not what exists in theory. That's why impulsive repricings can occur even in assets with large total supply, because total supply is not the binding constraint during a squeeze. Immediate float is. Seasonality and calendar flows deserve attention. Asset managers reset risk at quarter and year boundaries. Tax-driven moves, redemptions, and new mandates cluster around those dates. If fresh risk budgets arrive as exchange float is tight and narratives favor infrastructure and settlement, digital assets can experience outsized moves. Seasonality is not a guarantee, it's a tendency. If you treat it as a rule, you'll get humbled. If you treat it as a wind you can tack with, when other conditions agree, you'll understand why certain windows carry more weight. Retail pitfalls are predictable, which is why professionals design around them. Anchoring, expecting last month's behavior to persist, keeps people frozen during regime shifts. Recency bias, overweighting the last candle, makes people chase tops and sell bottoms. Leverage without a plan turns a tool into a detonator. A healthier approach is to define what would disprove your idea, size so that you can survive being wrong, and pre-commit to actions at signals you can measure. It won't make you perfect. It will keep you in the game when the tape gets loud. Fast FAQ, narrative style. Will XRP literally disappear from exchanges? No. What disappears is the willingness to sell at yesterday's price. The UI still works. Quotes just move up the ladder. Don't big moves just crash back down? Sometimes. In supply squeezes tied to structural adoption, pullbacks often set higher floors because the driver isn't one headline. It's a change in who holds the coins. Can't market makers just provide more liquidity? Only if they can hedge at acceptable risk. When hedges fail, they reduce size and widen spreads. What about regulation? Sensible frameworks don't kill settlement assets. They route capital into compliant wrappers and custody, unlocking buyers who were interested but constrained. What about other chains? It's not winner takes all. Different pipes serve different flows. But settlement layers with speed, finality, and cost predictability are scarce, and scarcity matters when institutions write requirements. What if the macro backdrop worsens? Shocks can still happen inside bear tapes. They're just messier and more transient. We are not predicting, we are mapping conditions. Mid-video cliffhanger, and it might sting. The real trigger may not come from inside crypto at all. It may come from a different market, sovereign bonds, FX basis, funding stress, that nudges policy tone just enough to open the risk window. Crypto doesn't need a crypto-native story to move. It needs a risk window plus a thin float plus a credible path to utility. When those three align, the headline you read after the move will probably over-explain what was essentially mechanical. Rehearse a day on the tape during an acute crunch. Asia opens quiet. A steady buyer leans on bids. Price drifts up a few tenths. Europe comes in. A bank desk circulates a note upgrading digital assets allocation. Baskets buy. The US opens. Macro futures bounce. A policy speaker hints at flexibility. Algorithms kick. The first liquidation wave tags shorts who got greedy last week. Funding jumps. Basis widens. Arbitrage desks deploy. Spot demand climbs again. Order book depth looks hollow 2% up. OTC desks quote above the screen. A second liquidation wave hits. The chart compresses time. By the close, the instrument is trading at prices that none of the morning narratives anticipated. That's what a squeeze feels like from inside the day. On that kind of day, your biggest enemy will be the urge to narrate. The tape moves first. Clean narratives arrive later. If you are executing a plan, you'll respect the signals you prepared for. Reserves, spot leadership, depth, rotation, OTC tone. If you are improvising, you'll chase when you should wait and wait when you should act. Plans beat vibes. Even a simple rule like no new decisions during the first 15 minutes of a liquidation cascade can save you from becoming forced liquidity for someone else's exit. Now, the relay effect. A push begins on one venue where a large buyer has relationships with the book, quotes their lead. Arbitrageurs relay price to other venues, buying laggards and selling leaders to flatten. If network congestion or custody friction slow the relay, gaps persist longer, inviting momentum funds. Meanwhile, AMMs that price off oracles update with a delay. Trades against them experience slippage that looks worse during volatility. That's how a localized flow becomes a cross-venue regime shift. When the dust settles after the first shock, the story isn't over. Consolidations at higher levels are not boring. They're information-rich. You watch whether dips refill quickly, whether basis resets, whether funding cools without price collapsing, whether OTC tone stays firm. Healthy consolidations feel uncomfortable because they don't grant perfect retests. They hold above breakout zones and force discipline. That discomfort is a feature, not a bug, of structures driven by real demand into thin float. Let's zoom out and tie the threads. The world is digitizing financial assets, leaning into instant messaging standards and shrinking settlement windows. Institutions now have compliant on-ramps, custodians, and wrappers. Exchange floats are thinner than headlines suggest because much of the supply lives in places that don't supply fast liquidity. Liquidity cycles pulse. When a pulse lines up with thin float and a credible path to utility, repricings happen the only way they can. Suddenly. Everything I'm saying sits under one umbrella. This is not financial advice. It's a map of mechanics so you can see what professionals watch. If you prefer certainty, markets will always feel hostile. Certainty appears only in the rearview mirror. If you prefer preparedness, you can thrive by planning for conditions rather than predicting exact outcomes. Conditions you can observe outcomes you can influence only by your own behavior. Let's bring Flare and adjacent rails into the conversation as a teaser for next time. Interoperability and data-rich smart contract layers that connect into the XRP ecosystem act like multipliers. They don't replace settlement, they route more use cases toward it. Price oracles, cross-chain messaging, and programmable payouts expand the surface area of demand that ultimately settles through fast, final rails. When peripheral networks improve, bursts in one corner transmit faster to the core. We'll unpack how that works, how to separate marketing from substance, and how to spot the integrations that matter. All of this still comes down to behavior. Most viewers will nod along and then wait for certainty. Certainty never arrives. What does arrive is a messy bundle of signals, some clean, some noisy, that together tell you the distribution is shifting. If you wait for the headline that says XRP supply vanishes, you're reading the past. The forward view is thinner offers, stronger spot leadership, warmer basis paired with arbitrage, and OTC tone turning firm. The forward view is rotation into settlement and utility names while yesterday's leaders stall. The forward view is a playbook you write when the room is quiet. Here's a compact checklist you can write notes and keep. Exchange. Reserves down over 7 to 14 days across multiple venues. Spot up first with perps confirming second. Funding modest, basis widening enough to attract arbitrage desks. Top of book depth thinning while price grinds higher. Settlement and utility names showing relative strength as prior leaders stall. And OTC quotes that consistently sit above the screen during pushes. 3 of these means pay attention. 4 or 5 means stop predicting and start executing your plan. Name the emotions ahead of time so they don't name you. Boredom when nothing moves and you question your thesis. Surprise at the first impulsive candle you expect to fade. Disbelief at the second candle you tell yourself is manipulated. Fear as you want to buy, but you're convinced it's the top. Capitulation when you finally buy high or sell low and the market does the opposite. Euphoria as you believe you've cracked the code. Regret when you realize you were trading your feelings. The antidote is not superhuman willpower. It's pre-commitment. Rules written in calm language that you follow when the tape screams. So what happens the day XRP vanishes? The screen still shows buttons, but the experience changes. Spreads widen, quotes shrink. Jumps between ladder levels grow. Market orders slip further than expected. OTC desks say, we can fill it, but not at that price. Social feeds react after the first leg, not before. Analysts who were bored last week explain yesterday's move with perfect confidence. Floors don't give back easily. Ranges form above anyone's comfort zone. That is what disappearing looks like, from the inside. If you're still with me, here's the uncomfortable truth. XRP does not need a miracle to print double digits. It needs a window where demand outruns float while macro winds lean supportive. It needs spot to lead, books to thin, rotation to cooperate, and infrastructure to catch the flows. Those windows do not announce themselves. They open, they accelerate, and they close. You cannot control the window. You can control whether you're prepared when it opens. Write your plan now. Decide what will make you add, what will make you reduce, and what will make you stop. Decide how you'll measure reserves, depth, and basis. Decide what you'll do if you're wrong. We'll keep covering this with zero fluff. Mechanics over memes, signals over slogans. Next episode, we'll dive deeper into how adjacent networks can route liquidity towards settlement, how to sanity check on-chain metrics that can be misleading, and how to avoid being exit liquidity when the tape finally heats up. Until then, respect the data, respect the risk, and remember, markets reward preparation, not reaction. This is Matrix Millionaire, clarity over noise. If this helped you see the market with sharper lenses, tap subscribe, turn on notifications, and drop your smartest supply squeeze tell in the comments. I'll pin the best one so the whole community learns from it. The day XRP's exchange float feels like it vanished won't be the day to start thinking about mechanics. That day is today.